Every single state has laws that allow local governments to forcibly collect delinquent property taxes on a home. In this video, we're going to walk through with you the two different ways states go about doing this, how a home can be saved from tax foreclosure, and then why some investors take a liking to investing in these situations. Regardless of where you live, when a homeowner fails to pay their property taxes, the government files a prevailing lien against the property. At this point, title on the home is clouded from a sale until it's actually paid off. So with the lien now in place, there's going to be a series of legally required notices to let that homeowner know that things are starting to get serious. And after all of those notices, the tax authority files a notice of action at the recorder's office and publishes that action in the newspaper. Typically, what's being announced to the public is a date for a public auction in which the government is going to try to get paid their dues. So depending on your state, the winning bidder at the auction will receive one of two things: a tax lien certificate or a tax deed. So let's break those two down. In a tax lien certificate sale, the government is merely selling the lien they placed on the home. So the homeowner, they're going to actually keep the property for at least the time being, but the amount that's owed is then sold to an investor with interest. So in 98% of these cases, the property owner pays off that tax lien with added interest to this new investor. But if you fail to pay back the lien amount with interest by a predetermined date, then that investor is now allowed to actually go and foreclose on the property. The second way that this happens is with a tax deed sale. So with a tax deed sale, instead of merely selling the lien on the home, they're actually just selling the entire home altogether. So when investors come to these auctions, they're there to, purchase the property itself. Thankfully, homeowners still typically have a chance to save their home, even after the auction occurs. And that's because of what's referred to as the upset bidding period. After the auction date, there's this time frame for other investors to overtake the current winning bid. Until that upset bidding period elapses without a challenging bid, the homeowner can still come forward to redeem the property. There's a lot of opportunity investing in property tax sales, and like everything else, that's because there's also a proportionate amount of risk involved. So thankfully, you can reduce a lot of those risks, or at least some of those risks, by doing some due diligence prior to the tax purchase. The first thing is to check for other liens on the home. Thankfully, prior mortgages and other problems, they usually get those ones are going to get cleared at foreclosure. However, things like municipal liens and code violations, those types of things, they remain on the property through the sale to the new buyer, and so those are going to need to get cleared immediately thereafter. Another tricky thing is that no one's going to just let you into the home, right? There's no public showings going on. So you have no clue what condition the property actually is in. If you can manage to get property access somehow, you might be able to avoid buying a literal meth lab or something, right? So whether you're a real estate investor or a homeowner facing foreclosure, the next best move is probably talking to a foreclosure attorney or even a real estate investor like ourselves.